Right. Afternoon, everyone. Thanks for joining and attending. Let me introduce myself. I'm Chris. I'm from Kenanga Investors. I think some of you have joined our previous sessions in the years past. Thank you again for supporting us. So I'm here to take you through a bit of our market outlook for 2026 by going through the various key geographical areas from US and also to Malaysia, which of course is our home market. So I'll bring you through a bit on the global side before moving in to talk about what is the outlook for Malaysia. Okay, let's start with a bit of review on how markets did last year. So this is the returns that you see in US dollars. So last year, the top performing markets were Korea, Japan, and Hong Kong, whereas the underperformers were Thailand, Philippines, Australia, and also Malaysia, unfortunately. So in Malaysia, I think only the KLCI ended the year slightly positive, whereas the other indexes like the small cap, Sharia index, and the FBM 100 was all down actually. So aside from some of the banks which did very well, I think the broader market took a bit of a hit. Small caps especially was down 12%. In terms of the ringgit, I think last year was a bumper year for the ringgit, up more than 10% against the US dollar to 405. So let's take a look at what we think the year will unfold for all the key regions. So in half an hour, I'll just try to give you what the key gist is for each region. Of course, there's not enough time to go into all the details, but just to give you an outlook on where growth and also monetary policy is for 2026. So for US, I think US growth has been very resilient. I think last year we'll come in close to 2% growth, and this year growth is expected to remain stable. So despite the past few years of doing well, I think the US is still not expected to enter into a recession at the moment. In terms of inflation, it's high, but it's coming down towards 2.8%. So what has been driving the US economy last year is actually the investment cycle. So I'm sure you heard a lot about AI and investments in data centers, and that's been one of the factors helping US to grow. So you see the bar in red shows you that the tech investment in the US contributed a majority to the growth last year. And consumer spending has been number 2 and also been very strong. So in the US, I think the positive thing is that we are in the midst of an interest rate cutting cycle, which tends to be positive for both US and global equities. So the Fed has actually cut interest rates for the third time last year in December, after cutting by 100 basis points in 2024. So this year is a bit debated. I think the Fed members have guided about 1 cut, but the market thinks there could be even 2 or more interest rate cuts this year. And also the Fed has announced that it will resume buying treasury securities. I think the simple explanation is that they're going to continue to inject liquidity into the market. So that tends to be positive for equities. So the outlook for the Fed is that the US economy is one where I think the unemployment rate is still manageable. It is not too high or too low at the moment. And also the job market, although there's some initial signs of weakening, but it still remains, for all accounts, pretty stable, right? And inflation, the good thing is that it should moderate to 2.4%. And why is that important? Is that when inflation is low, it gives the Fed the room to cut interest rates. Because when the inflation is high, they have to raise interest rates to fight inflation, right? And that tends to be bad for stocks. In terms of tariff, I think tariff wars have taken a pause. There's a lot of topics here, but just to summarize is that most of the trade deals with the world has been already finalized. I think the key one is with China, and that's undergoing some pause at the moment, and they will only revisit perhaps at the end of the year. Of course, there is also a decision pending from the US Supreme Court on whether the tariffs are legal or not, and we'll find out, I think, pretty much very soon this month. So the key message here is that while the tariff landscape is still quite complicated, you can see all the numbers here, but at least it's the uncertainty has cleared already versus last year where there's still a lot of uncertainty. So a lot of rates have been fixed with respective countries. Okay, moving on to Europe, I think Europe is still in a slow growth environment. I think next year forecasted growth at 1.2%, which is still pretty decent for a mature economy. but not the most exciting. So I think the US domestic demand has been driven by investment, the need to actually invest and upgrade the infrastructure which hasn't been upgraded for many years. But the challenges for Europe remain the political issues in France and the declining export competitiveness. In terms of the European Central Bank, the ECB, I think they have paused, last year, for the most of last year. And this year, they are expected to also be on a cautious stance, watching for inflation numbers to come in before deciding further. Okay, let's move on to China, which is the third and one of the most important economies, especially for us in Malaysia. I think China has been struggling with deflation and the property crisis, as you all know. So I think the way we see it is China is stuck between the new economy and the old economy. So the old economy, as you see in this slide, is the economy of real estate, of property, which still has been doing very badly. So if you look at the fixed asset investments and the dark blue line, which shows you the real estate investments, it's still down, close to 30% in the last, I think this was November's numbers, if I'm not mistaken. So it's actually been declining a lot. And especially the property prices are still on a slight downtrend in November. So they are still stuck in a deflationary trap in terms of the property sector, which has caused their GDP growth to also come down, slightly. But I think what's interesting about China is that aside from the old economy, there's also the new economy where the government's focus is on actually building up a lot of the technological giants that you see in the world today. So in terms of tech, China is one of the most advanced countries in terms of manufacturing, in terms of EVs. I mean, even in Pavilion downstairs, you can see all the Chinese EVs that are coming in. And they're very high tech, very good quality and very worth it for the price. And you can see that the government is actually focusing a lot of resources in developing this. I mean, not just EVs. I mean, EVs is the most visible, but they're actually putting a lot of resources into robotics as well, going to challenge Tesla in terms of coming up with a humanoid robot. In terms of the semiconductor development, they're also actually, they're a bit behind, but they're actually putting a lot of money to catch up. In terms of the artificial intelligence also, the Chinese models are actually only a few months behind US in terms of capability. So we do see, some opportunities in China despite the ongoing, property downturn. So let's talk about the elephant in the room, which is AI, which the key question is everybody's asking, is AI a bubble? If I invest in AI, is it going to be very dangerous? Am I going to lose money? I think it's important to take a step back and look at what is AI. Bill Gates, 2 years ago described AI as the most important thing that he has seen since the development of the GUI. And GUI, what it means is the graphical user interface, which where Windows was created. Last time when we used PCs, we used DOS and we used to type in our commands. Then it shifted to Windows, which was a major revolutionary technology in computing. And AI is another key revolutionary technology that will change our lives. And this is a chart on the left, shows you the wave of technology cycle that happens throughout the last century. So you can see the rise of PC, the rise of networking, the rise of internet, and more recently in the 2010s, the rise of the mobile internet and smartphones. In the last 5 years, we saw the rise of cloud computing and the software as a service market with the likes of Microsoft, Amazon, Salesforce, all benefiting. And 2 to 3 years ago, we saw the rise of AI with the ChatGPT moment. And now we are in the third year of AI, and I think the advancements are getting more and more interesting, and it's continuing at a faster and faster pace every day. So the chart on the right shows you the CapEx, which is capital expenditure of the top companies in the world, which is Google, Amazon, Meta, Microsoft, and Oracle. So you can see the number on the right-hand side shows you that the spending by these four giants have reached almost $400 billion, forecasted for 2026. So imagine just these 6 companies are spending $400 billion to develop their AI, and they see tremendous potential in this. They're building data centers everywhere around the world, in the US, in Europe, even in Malaysia, in Johor, a lot of the data centers belong to these major hyperscalers like Google and Microsoft. So we see that this trend is still continuing and still remains strong. And what will the new developments of this year bring? Of course, we have all used AI, but through the internet browser and through the chat platform. But I think AI is so much more than that. And I think this year, the key development that people are talking about is actually AI agents, where you can give the AI agent a task and let it run for 1 or 2 days, and then 1 or 2 days later, it'll come back to you with the result, with the answer. You can give it research projects to do. You can ask it to, plan a trip from end to end. And this is the rise of AI agents, which are already starting to see in the US and will start to come to the rest of the world very soon. I think AI is contributing to a lot of physical and scientific discoveries as well. Countries are deploying it as part of their sovereign AI strategy. And also, that chart there, AI is going into robotics, where AI will actually power the robotics movement and give a platform for the robots to actually interact with the world. And we are going to see this with Tesla Optimus coming in this year as well. So there's a lot of new and exciting discoveries and areas for AI to grow into. So when we think about whether AI is a bubble or not, we need to think about what will the use of AI be, whether it's real or not. And to determine whether it's real, we need to look at the use cases, which is still multiplying by the day. So a lot of people ask, is AI a bubble when all of these are spending so much money? But if you look at all these companies, these are the biggest and the richest companies in the world. And most of them are actually funding their spending using their free cash flow, actually, funded by their profits and revenues, and also the cash on their balance sheet. So the spending is still mostly financed by real money. It is not, okay, to a certain extent there is a little bit, but it's not financed by debt, as we saw in the dot-com crisis, where everybody went to borrow money to invest in dot-com, right? Okay, there may be some segments of AI which are funded by debt and also startup capital, which is the startups, which is like OpenAI and Anthropic. But if you look at this, is the revenue projection of OpenAI, or the creator of ChatGPT. So from only 1 billion of revenue in 2023, the company is on track to close about 13 to 15 billion in revenue this year. That is a 13 times growth in 2 years. It's the fastest growing company in the history of the world to achieve this kind of revenue growth, from 1 billion to 13 billion. And the forecast is to reach 125 billion in revenue by 2029. Of course, that seems a bit like a crazy forecast, but if you look at it, OpenAI ChatGPT already has 700 million users worldwide, and only about 5 to 10% of these users are paying the monthly subscription of $20. Now, if AI can become more and more advanced, more and more smarter, and add more and more value to your life, more and more people will start to pay for this, and this will be part of the revenue stream for OpenAI. And that's not even talking about enterprise, which is their business division, and also their agent division, which haven't even started to monetize yet. So while this projection does seem, somewhat bullish, we think that will probably be partially achievable by OpenAI to support the spend. And of course, another question, if you look at whether AI is a bubble, is of course valuations. Now, during the dot-com crisis in 1999 and 2000, the top 4 companies were trading at a PE ratio of 50 to more than 100 times. So Cisco, Oracle, Microsoft, and Intel were trading at a trailing PE of more than 100 times. So you look at the top company in the world today, like NVIDIA. NVIDIA is trading at a trailing PE, that means the last 12 months, not the forward 12 months, of close to high 30s to maybe 40 times at most. So it is still nowhere near where it was during the dot-com bubble. That doesn't mean that it won't come down. That's not what I'm saying. It's just that the valuation point of view is nowhere near where at the extreme it was during the dot-com crisis. So I think for what we think is that, okay, AI might go up and down. Sometimes the market can get too hot at a certain point in time and suffer a correction. But I think overall, on a multi-year basis, it's still on an uptrend. And how will we invest in AI? There are many ways to invest in AI. I think the last 2 years, many people talk about NVIDIA, but AI is so much more than that. You have the hyperscalers, Microsoft, Google, Oracle. You have the AI software like, Palantir, Snowflake, ServiceNow. And you also have the infrastructure layer, which are those companies that actually provide services to the data center, like, GE Verona, even Siemens Energy, like the previous speaker mentioned just now. So the AI segment is actually very big, and there are actually companies across the chain that you can invest in. Certain companies might be overvalued at certain times and may suffer a correction, but that doesn't mean that the whole thing is overvalued. Okay, just to summarize, what is our global strategy? So I think for US, I think economic growth is still resilient, although there's some small signs of slowdown. But we expect the market to be supported by tax cuts, deregulation. So the government is actually deregulating a lot of industries in the US. And Donald Trump's One Big Beautiful Bill, which aims to actually boost corporate investment as well. So fiscal stimulus, we think, will be the key focus ahead of the US midterm elections at the end of the year. So Trump has also proposed what he called a freedom dividend of up to $2,000 per person earning below 100,000. So we think that the government will focus on stimulating the economy in the lead up to the election. So in terms of monetary policy, we also expect easing and interest rate cuts to help support the equity market. So as I mentioned before, AI thematic remains a key driver of equities, but you need to be actually selective on what you buy because certain stocks might be overvalued. So you need to look for those which are still undervalued. So that's why we put an emphasis on bottom-up stock picking for this year. For Asia, I think for China, we think it's important to be selective and positive for new economy stocks. So we still would avoid the old economy stocks like property, banks, construction, but we still like the tech sector. Korea and Taiwan are also beneficiary of the AI thematic, given a lot of their companies also supply to the US AI chain. I think ASEAN didn't do very well last year, but there's a chance of a rebound if the US dollar continues to remain weak. Okay, let me move on to Malaysia. No, just give me a second. Okay, so back to Malaysia, closer to home, where do we see the market this year? We're turning more positive for Malaysia. I think last year was a pretty flat year for Malaysia, nothing exciting. Most of the markets was actually flat to negative after a very strong 2024. So you do have to remember that in 2024, the Malaysian market did very well. I think most of our funds were also up more than 20%. But last year, I think it was a flat year. So I think this year, Malaysia will play catch up. We are still on an investment upcycle. If you look at the investment themes, I think the data center investments are continuing. So hyperscalers here just means the US big tech giants. In terms of renewable energy, the government is also actively pushing, solar, wind as a form of a new energy. And we think that is one of the investment themes in Malaysia. Infrastructure projects will continue in terms of rail, water, airports, and highways. Consumer spending remains strong, aided by the strong ringgit. And this year is also the Visit Malaysia year 2026. Corporate exercises such as IPOs, M&As, and REIT value unlocking will also continue. So in terms of GDP growth, I think last year will come in around 4.7. This year we're looking about 4.5. So still a very decent growth rate anchored by actually investments. In terms of fiscal reform, I think this is one area where the government has done pretty well in the eyes of foreign investors. So last year's budget deficit will be narrowed to 3.5%, slightly ahead of the target, and the medium-term budget deficit is towards 3%. So if you look at the chart there, I think in the last few years, actually the budget deficit was 4 to 5%. So a narrowing of the deficit is actually good for the economy in terms of the ringgit stability and the way foreign investors view Malaysia. In terms of inflation, I think inflation here is also under control. So if we look at where BNM thinks the inflation will be, it will be the range between 1.5% to 2%. So I think that is still an acceptable range for Bank Negara. So I think our economist expects that the Bank Negara will not cut interest rate this year after one cut last year. So I think the view is that if inflation and growth maintains at this level, we should expect no action from the central bank this year. So I think just to walk you through some of the themes that we see in Malaysia is that we are still in the midst of the investment upcycle. So there's a lot of acronyms here like the NETR, NIMP, NSS, Johor SEZ, but actually these are all just initiatives by the federal government to kickstart the investment spending, right? So NETR is the new energy policy, the 9 Malaysia plan, the Johor Singapore economic zone. So all of this is actually to spur companies to actually start investing, and we have already seen that in the last 2 years and expect to continue on this year. So if you look at where FDI and investment into the country was, it was up about 12% for the 9 months of last year, right? And some of the sectors that we like, are banks. We think banks will continue to do well as play on the broader economy. We think they give you good dividend yields also of around 5 to 6%. In terms of consumer spending, it will also be aided by the government handouts, the SARA program, which the government will continue, and also actually the foreign tourist arrivals. So I think this year is Visit Malaysia year 2026, and the actually tourism numbers have been actually increasing, and I think this year we should see about another 10% growth in terms of number of tourists, and mainly coming from China as well. So in terms of utilities and the new energy policy, we start to see a lot of the solar projects being handed out. So you see the large-scale solar projects, LSS, which will be actually increased. Now it's on the 5th round of contract awards, which is the LSS 5. So the LSS 6, which is coming out this year, will have another 2 gigawatts and will have 6 to 8 billion of actually engineering opportunities for companies in Malaysia. So we are actually positive on companies that are actually bidding and actually helping to build out the solar grid in Malaysia. In terms of data centers, I think it's continue to invest in Malaysia. After the last 2 years, we think that it will still continue. So in Malaysia, I think we can see that currently there is about 3.3 gigawatts of data centers under construction. But the total pipeline actually is 7.1 gigawatts. So there's actually still a lot of, data centers which will come up in the next 5 to 10 years, probably even double the amount by 2030. In terms of infrastructure projects, we saw the Penang LRT, the Johor ART come up, and also the airport upgrades. So I think as you all know, probably the general election would most likely be in 2027. So most likely the government will want to pump prime the economy this year in 2026 to create a feel-good factor ahead of the elections. So we expect more construction projects to be awarded this year. One of it is the Johor Singapore Special Economic Zone. I think the train system should be operational this year. And also the tax incentive will encourage many multinationals to relocate to this region from Singapore. Okay, some of these are just the details. I think I'll skip this. In terms of foreign shareholding, I think this was a bit of a surprise last year. Despite the decent economy, we did see foreign outflows from the Malaysian stock market, despite the strong ringgit. But we think that the foreign shareholding is actually at a multi-year low already. It closed the year at about, I think, 19%, which is the lowest in the last 10 years. So we think that, the foreigners have already probably done selling, and we see less pressure from foreign outflow this year. I think in terms of valuation, it's trading close to mean. So the market is neither cheap nor expensive, but given those catalysts which I mentioned, we still think there's probably upside to the market. So I'll just talk a bit about our funds that we offer here in Kenanga. I think I show this every year. These are some of our key funds. Bear in mind that the foreign funds are denominated in ringgit. So last year, the foreign funds were still impacted by the US dollar, which appreciated more than 10% against the ringgit. So despite that, I think the foreign funds are still up. For Malaysia funds, I think last year it was pretty flat. It was between -2 to +2. But bear in mind, in 2024, I think our funds did more than 20 to even 30% return. So if you look at the 3-year return, 3 to 5 year return, I still think it remains at a very respectable level. Most funds have done 30 to 40% return in the last 3 years. In terms of the foreign funds, like I mentioned, the Asia Pacific Fund, both the Asia Pacific and the Islamic Asia Pacific did decently well last year, up 16%. This was despite the strong ringgit, which took away about 10% of the returns. Global funds also did okay, but was impacted by the strong ringgit. So we do encourage investors to always diversify their investments. So do put a bit in Malaysia, the Malaysian funds, as well as a mix into foreign funds. In 2024, I think Malaysia outperformed the foreign funds, but last year the foreign outperformed Malaysia. So by diversifying, you do get a bit of a blended performance on a year-to-year basis. All right, so that ends my presentation. Thank you very much for attending.